So I'm joined today by Andy Taylor, the CEO of Stakk. The ticker code is SKK. They are our most recent stock recommendation for the Markets IQ and Vitti Capital. So Andy, thank you so much for joining us. Stakk is a really exciting looking company. I was just wondering if you can take us back to before Stakk existed as a name, back to the story of Douugh. How did that start, and why did you end up pivoting from Douugh?
Yeah, thanks for having me. Shoot, got to go back 9 years almost now. Crazy. Early 2017. I guess after the advent of the GFC, you saw this big wave of disruption coming in the retail banking space. And after stepping out of my last startup, Society One, where we were really trying to disintermediate banks from a funding perspective to help people access personal loans, I got quite passionate about going higher up the engagement chain into everyday banking. So, we sort of pioneered this, it became called as neobanking model, where we could use technology to build a better customer experience, but sit on top of an existing bank and their infrastructure. We set our sights early on the US market, listed the company in 20 pre-launch. I guess we rode the wave of Afterpay, and back then there was a lot of investor appetite to support consumer fintechs. So off the back of that IPO, we launched in the US and were scaling quite aggressively, especially in the first 6 months that we onboarded about 150,000 customers. But unfortunately, it was at the tail end of the cycle, if you like, and when interest rates violently changed, I guess in the space of 2 weeks, that really changed the outlook quite dramatically for us. Because at that point, we were burning probably about $1.5 million a month scaling the business. And, we'd gone from growth at all costs to cut costs and get to profitability, which at the point we were at, still finding product market fit, it was like turning the Titanic. So, many people don't appreciate that our entire cost base was in US dollars and we were raising in Australian dollars, and the exchange rate was also heavily impacted during that time. So, look, I guess as a board, we got together and said, look, this company needs millions in additional capital to scale as a consumer business. We've already invested heavily into the technology. How can we better sweat that asset? And naturally, looking at a B2B approach to license that to others was where it all started. So, we naturally pivoted to a B2B model that could enable us to, there was two key pieces of learnings we took out of that. One was distribution is everything. And secondly, is our biggest cost at that point in time was customer acquisition. So if we could align ourselves with bigger brands, with bigger customer bases, empower those brands, we've got a much more profitable operating model. And, we can align ourselves with bigger providers that power these brands to get into these brands, which is actually now what we're doing. Most of our sales is inbound through channel partners. And that set us up now to really, I guess, reset the business. We did a small acquisition late last year that gave us access to amazing distribution and a core group of customers, specifically fintechs and tier 2 banks. And this year we've really set about penetrating those customers and converting the sales pipeline that we've been building. So, it's been a remarkable turnaround.
Well, yeah, that I do remember that time that you're talking about. That was it did seem like every second company on the ASX was like a buy now, pay later company for a little while. There were so many of them. So you mentioned interest rates. Do you think interest rates, because we're probably seeing interest rates go up next year now, that seems to be where we're headed. Do you think interest rates will impact your business at all, the new shape of the company?
Look, I think we're in a very different space to where we were. We really have no revenue to speak of back then. We were still finding our feet. I think now we're a business that's on the cusp of break even, growing aggressively. I think once we're at that point of cash flow positive, it's a whole different world for us. Like any business, you're more in control of your destiny. You're less impacted by macroeconomic environments. You just put your head down and grow. So it'll certainly be a lot less stressful than it was back then.
Sure.
But look, all that really means is, the risk on capital dries up in the market. like we saw previously, right? So a big focus for us is to get to profitability so we can attract more institutional investors into the story.
So can we just go back to that pivot a little bit?
Mm-hmm.
So you've basically gone to providing infrastructure for, would you say, who were your competitors previously? Are these the companies
Yeah.
that were previously competitors?
Yeah.
So you're
The
kind of
irony
building the...
is, the irony is we're competing with the Current and the Robinhoods of this world aggressively, back then, you know, and it was only through, interrupt me, but there's a reason behind this. We set out to launch in America trying to innovate on core features to differentiate ourselves, but we were overlooking the fundamental features that we needed at an operational level to minimize fraud on the platform, which is rife in America. And we ended up plugging into all these different vendors, 15 odd vendors, where really if we could plug into one or two that could provide us a full suite of services, that's really where the idea for Stakk came from, embedded finance, which is consolidate your vendors and focus on the critical infrastructure that you need to be successful and profitable, as opposed to fly by night.
So you would say your current business focus came out of where you saw your biggest problem in the previous shape of the business. Is that
Absolutely.
okay?
Absolutely.
I got a couple of follow-up questions. So you said distribution is everything. So what do you mean? What do you mean by that? Like, how do you see distribution?
I think if you look at it from a consumer lens, Afterpay probably had the best distribution model I've ever seen because their growth came from merchants pushing that on to their customers. And their marketing cost was minimal to nothing. Likewise, when you're looking at a B2B model, the quickest way to shortcut a sales cycle is to align yourselves with bigger software vendors that are already entrenched with these providers. And in our case, it's core banking providers, it's processors for Visa, MasterCard payment rails. And, thankfully, we've got good partnerships and alignments with these providers that have taken a long time to build over time. And that was really from the RDBX transaction. And as I said, most of our opportunity is inbound through those providers, recommending us to these brands.
Okay. And maybe we should just get into your products in a bit more detail for anyone
Yeah.
watching. So can you take us through, in a nutshell, exactly what those products are? So you've got things like AuthIQ, RiskIQ. You've kind of touched on these a little bit, but what do these products actually do, just in simple terms for people who may not be familiar with the space?
Yeah, so I guess core to our thesis as a SaaS business now is we're using programs or brands' proprietary data to help them streamline their workflows. So in the case of CaptureIQ, it's mainly used for customer onboarding, through validating driver's licenses, passports, identification, documentation to ensure that that is not fraudulent, to reduce their risk and their losses as a program. A lot of these programs run their own balance sheets effectively, even if they're using a sponsor bank model. So if you can help these programs move the needle by a few percentage points on reducing fraud, it directly impacts their bottom line. It's worth a lot to them in terms of profitability and margins. So ultimately, through an API first approach, we also have an SDK product. Brands like Robinhood, SoFi are integrating our technology into their own customer apps to streamline customer onboarding, as well as the uploading of paychecks and validation of income related data as well, for them to make better decisions around advancing them capital. And this is now naturally moving more into non-bank lenders and banks that want to better risk decision their lending decisions to reduce losses, So really we're dealing with a lot of data that we're processing, and automating through artificial intelligence becomes a key part of that future moving forward.
Yeah, I imagine AI would be a big part of the future. So essentially you are a company that is, people can outsource to you, or other companies can outsource to you to make, I'm going to put this in my own words and you can correct me when I get it wrong, but to make like micro decisions or micro little pieces of workflow that just slot into their normal existing processes and you're just taking the annoying, niggly little bits that is kind of takes up a lot of time, and maybe they can't do that all that well. And you've just become an expert in these little pieces of process, workflow, decision making, whatever you want to call it.
Yeah,
And
spot on.
obviously, yeah, sorry, you go on.
Yeah, look, I mean, it's a niche area of the market that's very profitable, that's allowed us to entrench ourselves with big brands because we're actually eliminating a lot of human oversight as well. So that, it reduced their need for humans to, when you're passing over an ID to validate and look through that's in a very expensive resource. So we're effectively increasing accuracy and pass rates by using this technology.
And do you see that expanding down the chain? Like if at the moment, these companies might be using your product, I don't know how much, I'm just going to make up a number here, but let's say they're using your products for 2% or 5% of their workflow. Do you see that like just stretching out over time where you're taking more and more tasks off these companies?
That's certainly the plan. I think as we invest more in artificial intelligence and specifically agentic AI and agents, it's going to take on more of that workload to streamline the entire life cycle of some of these programs. And especially when you look at lending, you know, the, the key thing I like to say about lending businesses is it's easy to lend money. It's very hard to collect it, right? So all lending businesses are effectively collections businesses. So,
Yeah.
by helping these non-bank lenders better decision and then dynamically risk adjust people in real time using open banking data that's constantly pulling through their income and expense profiles, then you can dynamically decision credit risk. So if you think someone is on the cusp of defaulting because they've lost their job, you can take immediate action rather than waiting for that default event to happen. But then that spans all the way through to collections and life cycle on collections and repayments. And naturally for us, we're seeing this now move out of financial services and being applicable to other verticals and marketplaces, that where knowing your customer is becoming crucial to a lot of these platforms to limit bad actors and behaviors, whether they be, I use Airtasker as a great local example, it's an ASX listed company, but, it's vital that they know their customer because their reputation is attached to good behavior on that platform. So I think as more non-bank and non-financial services companies embrace fintech, we're naturally the partner that will power a lot of that. Because I actually think every business will become a fintech in some way, shape, or form. If they're dealing in payments, if they're lending, if they're dealing with share trading, investing, they've all got their own wallets. Uber as a fintech business now has its own digital wallet. Just an example.
Yeah, we actually kind of touched on Uber in our write-up on SKK. There's like Uber is the example of the company that made everything simple and one touch, right? Like you book something on your phone, you get into the car, you don't then have to, pay someone. It's done. Like it's that one button click transaction, which I guess is what you're helping other companies move towards, at least in some instances. So where do you see the bottleneck right now for your business, for the growth? Like, is it with onboarding new customers? Is it with integrating them? Is it actually getting the sales? Like, what is stopping your growth at the moment? Not stopping your growth, but what is the biggest impediment to growth for you at the moment?
Look, it's not really one of those businesses where if you add more headcount, more salespeople, you'll get the growth. I think it's very, for example, most of our business was done at Money 2020 in Las Vegas a couple of weeks ago because you typically in the US, they're planning their budgets now for 2026. They have a year end at the end of December. So it's making sure that you're in those budgets and you're keeping that pipeline moving. I think we're conscious that we've ingested some big brands and some big programs, and we want to make sure we properly execute on those. So, you're going to have this fine balance of new customer onboarding versus how do you penetrate the customers you've acquired and upsell new services. So I think if I look 12 months out, our focus is going to be more, how can we lean more into embedded lending as a service through technology and expand our product set? Because we've now got ourselves a really great brands on board that have huge scope to increase organic revenue growth from massive growth. But at the same time, we want to capture the market opportunities while it's there and run fast. So to run fast, we need to remain agile. We need to align ourselves with more distribution partners, and we need to look at other overseas markets as well and run as hard as we can. So capital is an inhibitor, but more from an inhibiting point of view if we want to get strategic on acquisitions to fast track that rollout, which we've stated in previous announcements. We look at it as a two-pronged approach: organic growth and acquisitive growth through strategic assets that can add new technology capability, customers, and distribution.
Okay, so you mentioned there getting a bunch of customers like at one conference right before the start of the new financial year. So is that something that shareholders should expect with your revenue growth and your contract growth? Should they expect it to be very seasonal in the US at least? Let's just keep it to the US. Should they expect it to be very seasonal and like to come in these big batches where you get a whole bunch of contracts at once, or would it be more steady across the year going forward?
I'd say more steady. I just use that as an example because it's probably the biggest industry events where you have everybody from the country in one place at one time. So it just makes having conversations easier, and you fast track a lot of discussions. But there's a few of those conferences spread throughout the year. But in saying that, we spent the first 6 months of this year betting in the acquisition and really leaning into that sales pipeline. And you've seen the last 6 months that coming to fruition. So as I said, in a previous announcement, we did expect us to focus on organic growth like we have, but also acquisitive growth in the coming months.
Yeah. So that organic growth, it seems like you're saying that that's definitely a very big opportunity. So I'm guessing that comes in both the form of, cross-selling the products you already have, which you've got maybe 5 off the top of my head. And then obviously it sounds like you're also leaning towards how do you grow that portfolio of products as well? Like what other services can you add? And if you can become the one-stop shop for these businesses as the API company that they spit a message to,
Yeah.
they're going to be very sticky and easy to gain that business, hopefully.
Yeah.
So one other thing, you mentioned overseas markets. Are there any in particular that you see as particularly attractive?
Look, the UK is an obvious one because of the maturity and I guess its adjacency to Australia. We obviously want to penetrate Australia. It's our home market to a certain degree. New Zealand naturally is part of that. And I think Southeast Asia is interesting because they're leapfrogging a lot of the levels that a lot of Western countries went through on financial infrastructure to catch up. So yeah, but look, don't get me wrong. We've got 200 community banks in America and they have close to 12,000 community banks, so there's huge room for us to grow in America. And that's really where the core of our focus is. It's just an enormous opportunity.
It seems like that's the easy win too, right? Because you guys have existing momentum in the US, you've got relationships, people can see it working. Like as soon as you go and try to sell into the Philippines or into Saudi Arabia or somewhere completely different, they're going to be wondering, are you going to get the compliance and risk stuff right? All that stuff needs to be looked at again. Just in terms of the US, who do you see as your biggest competitors over there at the moment?
Look, they range depending on the module. You're seeing the bigger guys like the Fiservs sort of acquiring their way into some of these segments. So in one hand, they're a competitor. On the other hand, they're a potential acquirer. I look at what Stripe's doing and they're moving more into embedded lending from a technology point of view, but that's more supporting credit card based programs. So predominantly they're still a payments provider, effectively card issuer. We are not doing card issuing, but we are trying to provide the underlying infrastructure to support those programs. So there's natural crossover there, I think, over time. But look, again, I think where people laugh that we've explained it as the boring component of the plumbing, but it's actually a lot of these bigger guys have overlooked some of these niche opportunities because they've typically been so focused on owning the core banking solution or the entire ledger solution, or So we like these niche opportunities because it's not saturated. It's wide open. Whereas traditional sort of debit program now has become quite saturated, whereas credit, and especially commercial credit opportunities, are wide open, we think.
So do you think there's any other companies out there doing exactly what you do? Or is it more there's some companies that kind of touch on some of the products you have, but no one's doing that you know of doing exactly the same kind of stuff?
Yeah, yeah. There's companies doing bits and pieces, I suppose. But I think
Yeah.
how we bundle it and how we sell that in, I think is quite unique. That's why we don't really like to give too much away, because hopefully we can demonstrate that by the sort of brands that we're onboarding here.
Yeah,
We have got a
absolutely.
very unique way of embedding ourselves into these providers.
Yeah. Okay. Cool. And this is maybe a tough question. I don't think there's even an answer for this, but like, do you have an idea on total addressable market? You mentioned, I think you said 12,000 community banks in the US.
Yeah.
Any idea on like what a total addressable market would be?
Well, look, we've always looked at it at more of a macro embedded finance opportunity level, which, by 2030 is well over 100 billion total addressable market, in the US. But that's sort of broken down to embedded payments, embedded lending, and sort of niche sectors. So I think, as we lean more into embedded lending from a SaaS point of view, that's not necessarily us becoming a payments lending provider. It's actually us providing the infrastructure to lenders to streamline and scale. As I said, the commercial lending market, especially if you look at invoice financing, where fraud is rife and our technology can be utilized to validate invoices, companies, that's where we see a huge opportunity right now.
I imagine that there must be some really big opportunities for this that people aren't really looking at yet. I'm going to say this, I'm being very vague, but like at the moment, you're looking very much at financial stuff, but there must be a lot of these micro decisions or little pieces of workflow that can be done via API in other industries that people really aren't looking at, like even creative industries and stuff like that. One that pops to mind, which is still probably financial related, but betting, I imagine there must be massive opportunities in the betting landscape for definitely the ID stuff and, the risk and compliance and all that kind of stuff. But yeah, it seems like if you wanted to, and if you're creative enough, there's no shortage of places where you can take this general theme of like, outsourcing short pieces of workflow. And at the moment, you guys are kind of specialized in, one area, but you can see that this is going to be somewhere that industry in general, like, the economy in general goes down this path of outsourcing little decisions. For me in my daily job, like I have a million little things that pop up where, they're routine, repetitive tasks, but they're slow and manual and annoying. And it would just be awesome if I could, give them to you or someone else to handle those decisions. And that's the really amazing, interesting thing about like AI in particular and how interconnected companies and stuff are becoming. Like it seems like we're moving away from the world of one company, and we've been doing this for a while, but one company doing everything, right? To like very integrated companies that are kind of relying on each other. And it feels like, sorry, I'm going on a bit of a ramble here, but it feels like global trade when we went to, reducing tariffs and reducing borders, and the countries, sorry, that are better at, producing coconuts produce coconuts and sell coconuts to other countries, and the countries that are better at making cars make them and sell them to other countries. And that seems to be happening now on a like company level. That's my ramble. I don't know if you wanted to add anything to that or any thoughts on it.
Yeah, look, you've touched on a point that we're quite passionate about. So if you look at global trade, and you look at sort of traditional trade finance or supply chain finance, what's particularly interesting for us is how can you use the power of our technology and the data to unlock the cash flow blockages that companies have to trade because simply they're not analyzing and streamlining their processes. They have the data in most cases to make better decisions, but they're still typically operating off legacy platforms and work processes. So how can we unlock those blockages from a cash flow lending point of view, which is where we're seeing, especially in commercial lending, the real area of opportunity now. It's no longer these 3 to 5 year personal loans. It's actually provide dynamic credit lines that are typically smoothing cash flow for 30, 60, 90 days for companies to keep moving and unlock that potential. So again, I think you're right. AI, and specifically agentic AI and agents, is where this is going, and removing human oversight. And instead of just decisioning up front and then going, right, that person's eligible for this, and you typically, if you're lucky, re-decision them every 6 to 12 months, dynamic decisioning is where things are going. And this sort of feeds into the social credit scores and things that are coming. You see China are quite advanced on that. But if you think about where that's going as a society, it's pretty interesting. Anyway, I'm going on a tangent. I've come back.
Interesting. Tangents are fine. Interesting is definitely the diplomatic way of putting it. It's either like the gateway to utopia or dystopia. It's one of those two things.
Yes.
Yeah, depending on probably who's wielding the power, obviously. So it should be an interesting future. I just wanted to touch on the financials of the company, which one of the points I make in the report that we've written is that like anyone who's looking back at, like, who's looking on CommSec or NabTrade, right, and they see the FY23, FY24, FY25 results, they're going to see a company that's gone from, I think in maybe 2019, you guys were making 1.2 million in revenue. It went down for a bit. I could be wrong on that date. Maybe it was a bit later than that. And then again in FY25, you've made 1.2 million in revenue, and you've lost 200K at the net profit after tax level. That's what is showing in NabTrade, at least. So anyone seeing that is not seeing a very exciting story at all. It looks quite, okay, these guys make $1 million. That's amazing. Not really. But since then, obviously, things have really kicked off towards the end of FY25, but certainly the start of FY26, things are starting to look really, really exciting. So you guys have now, I believe this is correct, surpassed your $8 million annual recurring revenue target. So you've exceeded that, I believe, in terms of what we could expect in the next 12 months of revenue. So that's quite exciting. So if you guys only lost 200K on a 1.2 million revenue in FY25 at a greater than $8 million revenue, obviously there's going to be some variable costs going up. But that's looking quite exciting. So my first question is, like, do you see this level of growth continuing? Because I think you made about close to 200% growth, maybe in the annual recurring revenue, or maybe it was your October numbers, in like 2 months or something like that, something close to that figure. Like, do you see that continuing, growing, slowing? Do you have a sense for that?
Yeah, so I think we're about 570 year to date on an ARR basis. Yeah, the answer is yeah. I mean, we're really putting the pedal to the metal now. And I think it's shaping up to be quite an exciting 2026. And again, that will be closing the pipeline that we have in front of us, organic growth coming from existing clients, and acquisitive growth that we will do now. We've got a very strong balance sheet that we can capitalize on some opportunities that we see in the market. So, it's a compound effect. I think I don't know if I mentioned to you, but, securing especially the Robinhood deal really made it noticeably easier for us to close off some of these other clients. We've now got a bit of a halo effect now of pointing to our solution being used at scale by some big brands. And I use that analogy of, nobody got fired for hiring IBM. If we can cement ourselves in a position of trust where we're the go-to provider, then you get a bit of, you get a lot of natural traction and a compound effect on that momentum. We're pretty excited about next year, I'm not going to lie, but this year's been a great turnaround. I think, to talk to those numbers, what you see in those numbers is a company that was going aggressively in one direction and had to slam on the brakes, pivot to survive and transition. So, I want to thank shareholders because it's been a pretty roller coaster ride the last few years, but those that have stuck with us are now, getting a good return. And I urge them to take a long-term view here because we think we're building something quite valuable.
Yeah, I agree. It does look quite exciting at the moment. Are you able to give your investors some insight into your costs? Like, I believe that you, correct me here if I'm wrong, but you're charging per transaction. Is that the way you're Right. And I'm guessing that obviously that's a very tiny amount. Obviously you're not charging a lot of money per transaction. You're working off volume. So how big are you able to talk about how big the variable costs are there, or what your kind of gross margins per transaction are? Can you get into that at all?
Yeah, I can actually pull up a slide on this that we showed investors during the capital raise, and we are actually going to put out a more detailed presentation shortly to give everybody a view on this. If you look at, we're predominantly a transaction-based consumption business, right? Which means that sort of over 60% of the revenue comes from us charging transaction fees that sort of range from 30 to 50 cents US um, to providers.
30 to 50 cents.
30 to 50 cents, yeah. So let me share this. Let's just share this if you can see it.
I don't know if we can share on this, but
Here we go.
can we?
Let me see if you can tell me if you can see over. You can?
Something's happening. Yes, I can see that. There, you go. You know this platform better than me.
Okay, can you see that? Okay.
Yes.
So we're sort of operating at 80% gross margin here. So, we have license platform fees, that obviously depending on the size of the program vary. And then we have minimum monthlies. So that's really to cover us, for the fixed costs, and I think I mentioned to you, hosting is mainly our biggest cost, right? So, why we're so focused on penetrating these bigger brands with bigger customer bases is if we can penetrate those customer bases, from a recurring volume on a monthly basis is where we make a lot of the money. So, typically this is existing customer base, existing customers constantly processing transactions on the platforms. And obviously as they scale their own customer bases, that obviously naturally organically scales for us as well. If you use the example of Robinhood, they've actually started to roll out to their gold tier customers first before they sort of move down to their broader customer base. So we are sort of beholden to the customers in terms of how they push our solution into their customer base. We have no control over the products or features to that degree. We're pretty invisible, but certainly neobanks naturally are driving a lot of that transactional volume, especially Chime. It's probably our biggest program. They're probably the largest neobank in the US, and dealing in that area of the market where pay stubs are a huge part of that volume. And they're certainly becoming the mainstream digital banking provider.
Yeah, that dynamic annual minimum spend is quite interesting as well. So that gives you guys some downside protection as well.
Correct. They're 3-year agreements. We typically have automatic 12-month roll-ons. And typically when we get to that point where we're doing contract renewals for a further period of time. So there's, I'd say, close to zero churn on this platform. The hardest part is getting past the sysadmins and the security teams in these businesses to actually enable us to integrate into their tech stacks. And, obviously, as you know, with these bigger enterprise businesses, they move quite slowly. Once you're in and you're plugged in, it's very hard to dislodge unless you do something drastically wrong. And typically that is you go down for a period of time and breach your SLAs to the point that it materially impacts their business. So obviously our SLAs are very strict.
Yeah.
As you can imagine.
Yeah. Well, it's just like Xero is a great example. Xero software is a great example of that kind of thing. Like no one, once you've got an accounting software, no one wants to switch accounting software because it's just way too painful. And so, they've had phenomenal growth, and now they raise prices because they're finding, okay, where can we push prices to, that until people actually decide to leave. But that's driving a lot of their profitability as well.
Yeah, naturally when you're in that dominant position, that's just a lever you can pull.
Yeah. And so Robinhood, I just did a quick Google while we were talking. Robinhood onboarded about 2.5 million funded customers in the first 3 quarters of 2025. So that's just a Google, that may well be wrong. So that gives us an idea on, at that 30 to 50 cents per transaction. And I'm guessing you might have multiple transactions in there for, one onboarding, for example, that would be possible.
Yeah, I think we're fortunate that Robinhood are on a major growth scale up phase with this new banking solution they've launched, which we're part of. So, Robinhood are naturally becoming a super app. Certainly SoFi now have just announced they're getting back into crypto in a big way. So again, they're trying to get a greater share of wallets of financial services for their customer base. And T-Mobile is probably really exciting because huge customer base with 132 million subscribers. They're making a big push now with their own T-Mobile's T-Life super app to try and get a greater share of that market by giving discounts on mobile phone bills and internet, home internet, so the bundle approach to value, if you like. So yeah, huge scope for us to do more with those businesses, as I said.
Okay. Just curious, like I'm probably going back in our conversation a little bit here, but just in terms of the products again, is there any one product that you see as the most important? Like, is there one product that is easiest to win business with or anything like that?
Well, certainly the CaptureIQ module is where we're getting a lot of the traction right now. But I think, as I mentioned, where we see leaning into more growth is going to be around the ScoreIQ solution, working with non-bank lenders and banks to better decision and reduce fraud,
Yeah.
and providing more infrastructure for a lot of these non-bank lenders to, automate their workflows.
That makes a lot of sense. I guess I'm probably going to be wrong here, but CaptureIQ seems like something that would be solving a problem that, or doing a task that absolutely has to be done. And so it's probably an easy one to sell on. And I imagine when you get into like the scoring, that it's probably something that it's less obvious to those businesses, but where you can probably add a lot of value.
Correct. Yeah. And one interesting thing about traditional lending software businesses is what I've found, especially in Australia, is a lot of lenders are running on Salesforce. So they've sort of augmented their CRM systems to become lending systems, but don't really have the ability to do full amortization or, streamline workflows around lending. I mean, in some cases, they're still using spreadsheets. Believe it or not, a lot of lenders are still using spreadsheets.
I believe
So
it.
when you look at those integrated workflows, you're going, there's huge scope to streamline non-bank lenders, because it's been a bit of a cottage industry to some degree. It's so commoditized. And it's funny how Salesforce have done a very good job capturing this market. You wouldn't have thought so. But that's certainly where we're seeing, and Salesforce are renowned for locking you in and ramping prices. They're not cheap. So,
Yeah.
in some regards, I use Salesforce as a good example because they've grown through organic and acquisitive growth, bolted strategic assets into this wider ecosystem, and done a very good job building a moat around their customers. So it's very hard to leave Salesforce once you're in. So we can learn a lot from that business. And I see a lot of similarities to how we look at strategy.
And so just back on the cash position as well. So are you able to give any insight into when you see the business hitting cash flow break even or even bottom line profitability?
Yeah, look, we're pretty confident we're on track for Q3 to get to cash flow positive break even. That's certainly our intent, and it's a big milestone for us once that happens. As you know, we've got a strong balance sheet. We just completed a $15 million placement. So, we're in a good position. We're ending the year well, and we've got a very good view now into what our pipeline's looking like in the next sort of 6 to 12 months on the existing product set. But if we can bring in new channels, new customer bases, and new capabilities, that certainly massively turbocharges things for us.
Okay, cool. And so just in terms of the catalyst then, so obviously Q3, potentially cash flow break even, that would be a massive catalyst. There's, we'll be watching obviously for any announcements around other deals that are struck, any new deals coming on. Are there any other big catalysts that you see coming on for that investors should be watching for?
No, it's more of the same. We've got a great sales pipeline that we're looking to close out and make further announcements there. And we'll certainly, we'll be informing the market on any strategic deals that we do. So really, it's putting your head down now. We're sort of planning for the new year and what that looks like. So yeah, as I said, I think it's going to be pretty exciting. We can now, the good thing about going into this part of the year is it quietens down a bit. So, we can really regroup. It's been a pretty crazy few weeks for us catching our tails. So it's just about actually properly onboarding. I mean, we've now onboarded SoFi, Chime, that they're now, billings are running through at the tail end of this quarter, so, we just want to make sure we properly execute now and be solid in our execution and come back with a bang.
Sounds good. And just on you personally, like what motivates you personally to keep doing this?
That's a good question, mate. I've evolved over the years because it's been a real journey for me, as an entrepreneur now for 20 years. I've had my ups and downs and had my failures and successes, and it's taking the learnings and trying to improve yourself. And, one thing I'd like to think is that I didn't like to quit. I like to really double down. I take my role and responsibility to shareholders very seriously. I put a lot of pressure on myself, probably too much. So certainly your mental health struggles, especially as a listed company, it's been a challenging time. But I think I'm starting to see we've turned the corner and we have momentum again. When we lost that momentum pulling out the US, that was demoralizing, not only for me, for the team, for the board, for the market. And I found, once you lose that momentum, it's very hard to get it back. So once you get it back, we've got to keep pushing now. We've got to build on that. It's got to compound. So that's where I'm getting the fresh energy from. It's becoming more about how big can we make this in a very short space of time. And it becomes about legacy, really, I guess, as you get to my age now, mid-40s. Priorities shift. But it's fun. I'm having fun, and I think that's the main thing.
That's fantastic. So yeah, you obviously have done a lot. You built Society One, right? You founded and built Society One. Do you want to tell investors about that at all? Your journey there, anything that you learned and from that?
Yeah, I mean, we could spend hours on that one, but I was in my late 20s when we founded Society One, so you're naively coming into a very established market, trying to take on the banks and thinking you can disintermediate them, and you need a lot of naivety, I think, to be an entrepreneur, because if you really know what you're up against, you never actually have a crack. And we had to pivot that model, because ultimately we wanted to foster a community of sophisticated investors and retail investors that could provide capital to borrowers and shortcut the bank entirely. Now that model was very hard to stand up and scale, and we ended up becoming a non-bank in a traditional sense. As a business of disruption, quickly became a commodity. And I think that gave me a lot of my inspiration around, or actually, you really need to revolutionize the whole customer experience here to disrupt. But when you're up against four big banks in such an entrenched market, it's very hard. So, lots of lessons, lots of mistakes, would do things very differently, but that gets you to where you are today. Yeah.
Yeah. Well, big banks in Australia are certainly a protected species. So it's not just them you're going up against. You're going up against the government and,
Exactly.
all the other institutions that back them.
It is. What does sadden me now is, now that we've successfully, I guess, survived the Holocaust of, I said, wrong word.
Yeah.
The last 3 years has been difficult. And you've seen a lot of businesses disappear. I mean, unfortunately, the startup ecosystem here in Australia is pretty non-existent. It's not what it was, and you don't want to see that. It's naturally that all these disruptors have fallen away, and it feels like the entrenched have all the power again. And that's not what you want to see. We want to see another round of innovation fueled in this economy. And I think it's partly because money was so cheap and no entrepreneur was focused on the fundamentals. I was the same, because you're getting encouraged by investors to grow, spend. Whereas what they should be teaching you is you need to be profitable from day one if you can. Think that way, because you'll build a sustainable business. And that's the real lesson that I've learned is, whatever you build, how does it make money? It's got to make money. You can't figure it out later. You may be able to do that in Silicon Valley with the investors that are there, but you certainly can't do it in this market. So investors want to see a return. They want to see it quickly, and that's fair enough.
Well, certainly it looks like you have those returns coming now. The next 12 months in particular for Stakk looks really, really exciting. So that's really all the questions I've got. I think you've given our investors some really great insights into the company and into yourself and the way you're thinking about it. Is there anything else that you'd like to add or any resources you'd like to point our investors to?
No, I think just please keep an eye on the announcements. We're definitely going to do more to keep investors educated on what we're doing, where we're going. I appreciate what we're doing is pretty nuanced and in some instances might be challenging to understand. So we had the AGM last week. We got a lot of great feedback from shareholders on what we can do to improve the messaging and communication. We've taken that on board. So we'll be doing a lot more of that moving forward.
Excellent. Yeah, thanks, Andy. Thank you so much for your time and all the best for Stakk going forward.
Thank you. Thanks for inviting me.